the manipulation of the data to fit a narrative is reaching torturous levels. To say that because interest rates are increasing less quickly, that somehow that means there's this wave of liquidity and this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers.
Hey guys, welcome back to Let's Talk Crypto. Bitcoin and Ethereum have taken a hit in the past week, with Bitcoin at $22,829.40, down 2.83% in the last 5 days, and Ethereum dropping 1.19% to $1,623.83. But the overall crypto market seems to be doing well since Powell's announcement of a 25 basis point increase. According to January's jobs report, there was an addition of 517,000 new jobs that month, almost tripling analysts' projections of 187,000. The unemployment rate also dropped to 3.4%, the lowest it has been since 1969. Pretty impressive. All these metrics are leading investors and pundits to believe that after one of the highest inflation environments in decades, the economy is heading for a soft landing. However, in his latest interview on the Blockworks Podcast, investor Mark Yusko said he's not buying it. He believes that the Federal Reserve and other powerful entities are fudging the numbers and manipulating data to create a false impression that the market is doing well. Meanwhile, Yusko himself had to lay off staff at his hedge fund for the first time in 20 years. Yusko suggests that what they are telling us does not match what's happening in the real world. Let's listen to Mark Yusko as he shares his views on what is really going on in the market. But before we do, please consider subscribing to our channel, as we bring you daily content on the latest crypto news. And now, let's jump right into the video.
I say this all the time that, sitting down, I'm 6'3". But when I stand up, I'm just under 6 foot because I have no legs. So X legs being short, I'm a really tall guy. It's just such nonsense. First it was X food and energy. And I was like, oh, geez, well, this shelter piece is kind of volatile now. Not supposed to be volatile. We kind of engineered it to not be volatile over the last 20 years by turning it into owner's equivalent rent. And then rent spiked. So the manipulation of the data to fit a narrative is reaching torturous levels. So but people believe narratives. I mean, that's the thing that I just don't understand, right? There's all this data in front of people that they can look at, and they could form a conclusion. But instead, they just listen to the man behind the curtain, right? Saying, oh, ignore the man behind the curtain. Hey, that person you see who isn't really the great Oz. I don't know. I'm frustrated by the way people listen to drivel and don't actually look at the data. I mean, it is idiotic to say that because interest rates are increasing less quickly, that somehow that means there's this wave of liquidity to push up stocks. That said, when everyone's on one side of the boat, when everybody's short, and literally everybody was short, like all the hedge funds, all the institutions, all the banks, everyone was short. But I'm really struggling because I'm a value guy, and I actually like to run analysis of cash flow and earnings, but these companies don't have that, and they're soaring on hopium that there's going to be some increase in Fed liquidity. Now, look, it is true that financial conditions since October have gone straight up. Right? There's been a massive unleashing of global liquidity, first by the Chinese, then by crazy Kuroda-san. So yeah, I get it that don't fight the Fed. Well, now it's don't fight the global central bankers because it's more than the Fed. But the Fed has not done any easing. I don't think the Fed has anything to do with what we call inflation. It's oil prices and used car prices that were triggered by the base effects of shutting an economy down, then turning it back on. And look, CPI perfectly correlated 16 months after M2 growth. M2 growth went negative for the first time in, I think, 96 years. Let that one sink in. It's been 96 years of constant money printing since the Fed was created, to diminish the value of the currency, to steal wealth from the masses and give it to the people at the top, which, right, income and wealth inequality is where it is. So mission accomplished by the Fed. But the challenge now is there is no pricing power for employees. How many announcements of 10,000 workers being laid off have you heard in the past month? Every single day, another company is laying people off. Our company, for the first time in 20 years, we had to let some people go. It's just never, we never got to that point before. And this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers. Again, the massive engineering, right, by taking people out of the labor force, making the labor force seem smaller, so the percentage of unemployment, those people are still working. But just because they turn 65 doesn't make them out of the work. But that's the way they do it. And the birth-death ratio nonsense. So I hear the narrative that people have crafted, and I hear the torturing of the data. The torturing of the data continues, but you go around and you look at economic activity, which is the true measure of whether wages are good or not good, or economic activity, it's not so good. In fact, some of it is downright abysmal, like plumbing levels we haven't seen since global financial crisis or the Great Recession the period, the tech wreck. I heard somebody say, "Oh, this is just like March 2009." Like, in what way is this like March 2009? I mean, other than the fact that you've had a short squeeze of the crappiest stocks, but in 2009 you actually had a Fed that was printing money at a rate we hadn't seen in decades. They were buying bonds. They were not, trying to shrink their balance sheet. So to say this is like 2009, just silly. We have a whole generation of people in the business that only know polluted data. And what I mean by that is, go back before 1995, for 100 years, we had a very cyclical, predictable set of cycles around the business cycle, the liquidity cycle, profit cycle, valuation cycles, and all the measures were mean reverting, they were normal, they followed very good statistical models. And then with irrational exuberance and Alan Greenspan, we entered the central banking era. And since Greenspan, we've been in a period of polluted data, where all of the traditional relationships broke down, whether it's GDP to market cap, market cap to GDP. I mean, if you think about it, right? The market cap, the equity market cap of an economy should be less than its GDP, right? Because it costs money to make money, right? There is a cost of doing business, but that's not where we live today. We live in this rarefied air of like 130%. Doesn't make any sense. We look at price to sales. 8% of companies have price to sales of greater than 10. Not price earnings, price to sales. That number should be sub 1. In 2000, it got to 4. And that was crazy. So that makes no sense. And people say, oh, well, zero interest rates. Well, we don't have zero interest rates anymore, y'all. We have 5. You can't look at a subset of polluted data and say that's normal. You just can't. But that's where we are. And it gets worse post 2009, right? The QE era made the pollution even more toxic. So now it's not just polluted, like it was polluted in the 2000 period, 2010 period, but now it's just toxic. The Fed is not adding liquidity. They're just not. The ECB, not. See, the ECB is now in the hot seat. Ms. Christina, she's got a problem. She is now the one that has to raise. She's 200 basis points behind everybody else. And that's going to be a tough one for Europe. Now, the European banks love it. and the European banks are going, bananas. But rest of Europe isn't going to like that very much, particularly the exporters, because it's going to strengthen the euro, and dollars continue to fall, euro is going to strengthen. But I still come back to PMIs are rolling over, industrial production is rolling over, new orders component of PMIs are rolling over. I don't see any catalyst for a strong recovery. And if the definition of soft landing is the Chuck Yeager, right? Any crash you can walk away from is a good landing. Okay, well, we're not going to crash, but I don't see us getting back in the sky anytime soon.
Are you buying the positive sentiment in the market? What do you think of Mark's perspective here? Let us know in the comments below. If you enjoyed this video, please make sure to give us a like and subscribe. Thank you so much for watching. This is Let's Talk Crypto, and we'll see you in the next video.